Welcome everyone. This webinar is brought to you by the Ohio Employee-Owned Network. We are a nonprofit training and outreach organization at Kent State University and part of the Ohio Employee Ownership Center. We focus on ESOP transitions and training. Today we have Accounting 101 for ESOP companies, presented by Bill Schramm and Pete Chudyk of Maloney and Novotny. Bill and Pete, take it away.
Sure. Thanks, Jay. This is Pete Chudyk. What we're going to talk about, as Jay said, is Accounting 101 for ESOP companies. And for those of you that may already have an existing ESOP, this may serve as a good refresher. And for those that are thinking about it or maybe are new to going through accounting for ESOPs, this may be a good intro for you. So what we'd like to do is I'm going to start. The agenda is essentially we're going to discuss briefly about the ESOP basics. And I'll be taking that. Bill will talk about leveraged ESOPs. And leveraged ESOPs are nothing more than an ESOP that borrows money to finance the purchase of the stock. And that typically is through banks, but more and more these days we're seeing sellers actually finance some or all of an ESOP purchase. Bill will also speak about the financial statement implications and disclosures. And then I'll flip back to me, where I'll talk about S corporations that own ESOPs and other tax incentives that the government provides to encourage employer ownership. So essentially, the ESOP basic is, an ESOP is nothing more than a qualified retirement plan, and it generally has the same requirements as other qualified plans. And if you think about a profit-sharing plan, you have eligibility requirements, what employees do you have to cover, full-time versus part-time, union versus non-union. All of those still apply to ESOPs just as any other qualified plan. Also, if you have a related party entity, another company that may have the same ownership, are those covered or not covered, those employees? Again, the same rules, and I don't want to get down into those specifics because that could be a course in and of itself. And then also there's vesting requirements. How much one's shares are allocated to a participant's account, how much do they own, when do you, and that becomes important, especially with an ESOP, because as you'll see later, that when someone retires or terminates and they have a vested account, a portion of their account, and the shares are allocated in the account, the employer, the company, will have to buy back those shares. We call that the repurchase liability. Now, an ESOP is different than other qualified retirement plans is because it's designed to invest primarily in employer securities. And primarily is never really defined in the code, but it's pretty much thought about and treated as if the ESOP has to own at least 50% of its assets have to be employer stock, which may become an issue to the extent that you have a very profitable corporation that may make additional contributions to the ESOP that's over and above what's needed to fund the buyback of the stock or pay off of the debt. Now, the ways that you get money into the plan is just as you would in any other qualified retirement plan. It's through deductible, typically through contributions. Deductible contributions, and they are limited as a percentage of a participant's wages. We call that the Section 415 limitation, which is the Internal Revenue Code situation. So I always think about it as a bit of a funnel. How much the neck of the funnel may be small or large, depending upon your employee base. How many people you have that are participants in the plan will determine how much you can put into a plan as a contribution, as a deductible contribution. And that's typically 25% of employees' participants' wages. Now also, just as an aside, you can put in deductible dividends if the employer is a C corporation and they're paid in cash. There's certain inherent limitations with those, but that is another way that you could try to get additional funds into an employer, into an ESOP to try and pay off the debt. Now, additionally, ESOPs differ from other qualified retirement plans is not only that it invests primarily in employer securities, it also allows loans back from the plan to the company in order to finance the purchase of those loans. Typically, with qualified retirement plans, you can't do that, or that's a prohibited transaction. There's a specific exemption for that. There also is a need where you are privately owned, where you're not publicly traded, that the employer stock is required each year to be valued. And there is certain information that must be disclosed to participants, but they're very limited. Oftentimes people think that, boy, if I form an ESOP, all of a sudden all the participants will learn everything about the company, including compensation, what I'm getting, what somebody else is getting. That's not true. Basically, participants have to be informed about the value of the stock and pretty much nothing else, unless the employer decides that they want to, or the management of the employer decides that they want to pass along other information to them. And then also, there is a requirement for ESOPs that they can only have voting stock in the plan, and also that in certain situations, pass-through voting is required. And what that means is that shares that are allocated to a participant's account, in certain situations, the trustee has to pass through that voting on those issues. And those are typically reorganizations of the business, sale of substantially all of the business assets of the company, and certain things such as that. And finally, under the basics is that this is an area just like other qualified retirement plans. It's not only policed by the IRS but also by the Department of Labor. And the Department of Labor has really stepped up its review of ESOPs, especially as it applies to, and a lot of the issues that they typically look at are valuation issues. Typically, the initial, I'm sorry, now we're turning over to Bill. Stepping on your lines here.
That's okay. Thanks, Dee. So to get the ESOP started, the first thing that you actually need to do is set up that qualified plan. As Pete said, it's a qualified retirement plan that's monitored both by the IRS and the DOL. So we want to be sure that we set up the actual qualified ESOP plan in and of itself. Once we have the plan set up, we of course need to get the shares into the plan. So that's typically initiated by the company. The company will borrow funds traditionally from a qualified lender, which many times is a bank, as Pete mentioned, and then those funds will immediately be loaned to the ESOP, so the ESOP can then purchase the shares from the shareholder. That's where we get the leveraged ESOP term from. The loan from the company to the ESOP is typically secured by the pledge of at least the shares, and that relationship with the loan going directly to the company and then being transferred essentially to the ESOP and creating that inside loan between the ESOP and the company, that may seem odd, and it may be a question of, can the ESOP get the loan directly from the bank? And the answer is yes, you can have a direct loan from the bank or the qualified lender directly to the ESOP, but the issue typically is there's no assets that are collateral for the loan at that point. So typically you do not see this set up. The bank or the lender is typically going to want to lend to the company because the company has the assets, the receivables, the inventory, the fixed assets that they can loan against. So this direct loan relationship where we see the loan going directly to the ESOP is not the norm. What we traditionally see is the two-step loan. Okay, and in this scenario, the bank will loan the company the funds. The company then provides those proceeds to the ESOP, creating the inside note between the company and the ESOP, allowing the ESOP, the plan itself, to use those funds to purchase the stock from the shareholder. So that's going to be the common relationship that you see, and we're going to go through an example of this a little bit later, and we'll go through this slide as we step through the example. To continue to go through some of the background and lay some of the groundwork for the ESOP and how we're going to account for it, it's important to note a couple things. First of all, the debt, whether it's a direct or an indirect loan, is going to be on the sponsor's balance sheet. So the company is going to hold the debt from the lender regardless of the type of loan that we set up. While the balance sheet is credited for that debt, the debit's actually going to go to a contra equity account. So there's no receivable set up from the ESOP. There's no asset that says it's a receivable, a loan receivable from the ESOP plan on the company's balance sheet. It's set up as a contra equity account, and this will all be incorporated into our example a little bit later. Annually, we'll go through and we have to recognize certain compensation expense that's measured at the fair market value of the shares at the end of the year. Again, we spoke about how an annual valuation for the share price is done for the company. So that will be applied to the shares that are released, and we will recognize compensation expense, which is a non-cash expense. We will recognize that annually on the income statement. As we said, the employer loan to the ESOP is not booked, so that inside loan that's made between the company and the ESOP actually is not an asset on the balance sheet of the company. We simply show the contra equity account to account for that. Now, Pete spoke a little bit about the dividends, and if dividends, it's important to really know what the goal and what the application of the dividends, if they are declared, what they're used for. If they're used for debt service, they should be a part of the allocation formula as shares are released. If they're not, we have to know, are they applied to allocated or unallocated shares so we can properly account for them, be it in equity or through that compensation expense. The compensation expense that results from applying fair market value of the shares to the shares that are released is part of operating income. So we're going to recognize that on an annual basis through operating. And if you have any unallocated shares, that's not part of your earnings per share calculation, which of course is going to be more important for public companies, which are more concerned with their earnings per share value. Finally, the repurchase liability. The assumption here is that it's not recorded on the financial statements. Now, if there is a put of employer shares before the end of the year, that liability would have to be booked. But in general, the projected liability associated with repurchase liability is not booked. There are certain exceptions, but in general, that is not booked. Okay? So to go through the example, and this is a lot of probably a lot of review, like Pete said, if you already have a leveraged ESOP, but we want to walk through and at least go through one example of all the debits and credits and how your balance sheet is affected. Our assumption in this case is that the company that we're looking at is valued at $10 million. Okay? There's 100,000 shares outstanding, and each share is going to be $100 per share. That's going to be our cost basis. That's our beginning basis of the shares. Our example is going to have 30% of the shares purchased by the ESOP, so that's 30,000 shares for a price of $3 million, and we're going to use the two-step loan that we mentioned earlier. Now, the collateral is going to be released under a special rule that allows us to use a principal-only allocation, which means our note between the company and the ESOP needs to be 10 years or less. So we'll go through an example specifically of that at the end, but just know that we're going to use principal only to release the collateral. Again, the $3 million loan that we have is a 10-year loan. It's going to be at 8.5% interest, and it's actually going to be a mirrored loan. Okay, a mirrored loan is one that the terms are identical between the bank and the ESOP. So, you know, the company in this scenario has a term note with the bank. They also have the inside note with the ESOP. So in this case, both notes are going to be at $3 million. Both are going to be amortized over 10 years equally, and both are going to be at 8.5% interest. So it's pretty clear why that would be called a mirrored loan, and that's typically set up so your principal payments can match your tax-deductible contributions. As the company makes contributions into the ESOP and the ESOP can repay that loan, those payments match each other, and that's where the mirrored loan term comes in. There are cases where you have a non-mirrored loan, which is simply the terms do not match, and typically what happens is your term with the bank is shorter than the term with the ESOP on that inside loan. You know, you could have a 5-year term note with the bank, and your your inside note with the ESOP may be a 10-year amortization. This is done when you clearly do not need the deduction, so it's more popular under an S-Corp situation, which we'll talk about some of the S-Corp differences a little later on. So kind of using those assumptions and remembering that the debt is on the sponsor's balance sheet regardless if it's a direct or indirect, and that the offsetting entry is going to be to unearned ESOP shares. We'll walk through how these shares are accounted for and how they get booked to our balance sheet as we go through each year. Okay? So if we look at our balance sheet prior to any transaction, we see we have $10 million in assets, $5 million in debt, and $5 million in equity. So this is the balance sheet prior to the transaction. At this point, what we need to do is book the loan and create the unearned ESOP shares account. So remember from our example, we took out $3 million in debt, so our debt increased $3 million, and we booked the contra equity account, the unearned ESOP shares, for $3 million. Okay? That's our 30,000 shares at $100 per share. So you see we still have a $10 million balance sheet, but the equity section looks substantially different. Really getting down into the debits and credits, we can see the cash coming in from the bank. And again, this is all from the company's side. This is how the company would record the ESOP plan. So it's not looking at plan financials. It's important to note that. So this is cash coming in from the bank, you know, accounting for the term loan, really like you would do with any term loan. So recording the cash receipt and the bank proceeds. And then at that point, basically recording that mirrored loan. So remember, we said you don't book a receivable, you don't book an asset for the receivable from the ESOP. It's really booked through this unearned ESOP shares entry. So you create the debit in equity, the contra equity account, and move the cash to the ESOP. The ESOP at that point can use that cash to purchase the shares. So kind of revisiting our diagram here, you can now put some numbers to this and see the $3 million coming from the bank, and when we recorded the loan and the unearned ESOP shares, creating the inside note so the ESOP can then purchase the shares from the shareholder. It's a little easier to see as we start to go through and apply some of the numbers to the situation. So now that we have our debt booked, we have our unearned ESOP shares booked, you know, annually we're going to have contributions into the ESOP so the ESOP can repay its loan. So the mechanics on an annual basis result in another set of entries. So as I said, the company makes contributions to the ESOP. The ESOP repays that inside loan, and then shares are released from that unearned ESOP account. At that point, those shares are then allocated to the individual's participant account, which is laid out in any plan documents that have been created when the qualified ESOP was set up. The allocation formula is typically based on compensation, and it's traditionally a ratio of the individual participant's compensation to the total plan compensation. That ratio is then applied to the shares that have been released, and that's how each individual participant receives shares in their account. Okay? So we've set up our debt, we've set up our contra equity account. Now we're going to start making the annual loan payments and allocating the shares. Again, going through a diagram of how it looks, it's very straightforward, but sometimes it's easier to see in the way of a diagram. You know, the company will make the contribution to the ESOP, so it'll make the tax-deductible contribution to the plan. The plan then repays that inside loan, and then the company can repay the bank. Again, it's noteworthy that this is a mirrored loan, so all those numbers remain the same in our scenario. Okay? So we've set up our debt, and as we pay down our loan, the entry looks very similar to any term note that you would pay down. You know, you're going to reduce your bank loan by your principal payment, you're going to book your interest expense, and record the total payment on that bank loan and interest. So now what we have to do kind of the last step in recording this is releasing the shares, okay? You can see that we've documented here 3,000 shares released at a value of $80 per share. You know, speaking to the value, that's done annually. As Pete said, you get an outside valuation if you're a privately held company, and that value is applied to each share price that's currently in the plan. The share release is based on a prescribed formula. Remember, we are using the special rule of principal only, so we are basically taking our 30,000 shares over 10 years and doing that on a straight line basis. So we're going to release 3,000 shares a year, and the assumption here is that it's going to be at $80 per share. Okay? Remember that compensation expense that we're going to recognize on an annual basis running through our income statement is based on fair market value. So the fact that our shares are valued at $80 versus the $100 cost basis will affect our income statement, and that's a non-cash expense recognized annually. Okay? This is going to be the entry recording that ESOP contribution and the related release of the shares. Okay? The $240,000 is simply going to be the value at $80 per share multiplied by the shares released, the 3,000 shares. And the amount that's relieved from the unearned ESOP shares account is always going to be the shares released at the original cost value. So that $100 cost will remain what's released from the unearned ESOP shares on an annual basis. The difference is going to get put to paid-in capital. So in this case, paid-in capital is actually reduced to account for the depreciating fair market value of the shares. Okay. If we take the same example, except we increase the value of the shares to $120 per share, we can see that the compensation expense increased, although it's still calculated the same, taking the $120 per share multiplied by the shares released. The unearned ESOP share release is going to be the same number because, again, the cost value does not change on that, and the shares released is the same assumption. So in this case, our additional paid-in capital picks up $60,000, as that's the difference between the fair market value and the cost basis. So at this point, from the company's standpoint, we've booked our debt, we've created our contra equity account, we've started making loan payments, and we've released shares and booked our annual compensation expense. So those are the entries, the loan repayments and the release of shares. Those are going to be the entries that are made on an annual basis. Okay? The debt and the contra equity account are only going to be booked at the time of the transaction. So as we make those loan repayments, we release the shares and book our annual compensation expense. That's what's done on an annual basis. If we look at how it would line up between our book tax differences simply based on our share value, you can see if we take an assumption of $2 million in earnings before any ESOP entries, you can see how we are affected on the GAAP side in that we reduce our income by the ESOP expense, which again is just our fair market value times the shares released. Our interest expense associated with the debt payment to the bank results in net income of $1,505,000. On the tax side, all the assumptions remain the same with the exception of the ESOP expense. Remember, the company made a $300,000 contribution to the plan, so that's going to be fully deductible on the tax side. So you will have a book tax difference for that loan payment versus the contribution into the plan. Looking at it for the appreciation and fair value, where the value of the shares went to $120 a share versus going down in the previous example, you can see also how the assumptions remain the same on the tax side. The interest remains the same payable to the bank. The only thing that changes here, of course, is our ESOP expense, showing how that would be affected by the increase in share value. Okay. So we looked at the assumptions of releasing 3,000 shares in our example.
Bill, excuse me.
Yeah.
Maybe this is a good time between slides here. We have a question. Can you see it in the chat box there?
Yes. So the question is, you indicate the average price is used to record compensation expense. Do you take an average of the current year and last year's price, or simply the current year's price? In that case, you actually just take the current year's price. So you take that current valuation, and that's the price that you apply to the shares that are released. So, okay. So looking at the shares that are released and the calculation applied to that, typically under the regs you take principal and interest paid for the year, and you create a ratio and divide that by the principal and interest for the current year plus all future years. Once that ratio is created, you multiply that times the shares that are unallocated, and that's traditionally how your shares released are calculated. If, like we said, if the inside loan between the ESOP and the company is 10 years or less, you can actually use a principal-only method, so you're not taking interest into account. So that's actually the method that we used in the example above. So the way that we came out with that 3,000 was simply taking the 30,000 unallocated shares. Okay, we had the inside loan of 10 years, so that's within the rules. Our beginning loan amount was $3 million, and our current year principal was $300,000. So you can see we took the current year principal payment of $300,000 divided by the current principal plus all future payments, which in this case is the beginning loan amount since it's our first payment, multiplied it by our unallocated shares, which is all of them at this point, resulting in the 3,000 shares that we used in our calculation. And if you were to run this out for the next 10 years, you would get 3,000 shares per year, which is in line with the rules and the limitations under the special rule that we used. Okay. Under the regs, if we took the same assumptions and we added some interest expense to it, you can see how our numbers would change. Okay, we would add some interest to the current year payment. We would account for the total interest incurred throughout the course of the loan, and you can see it actually results in more shares released on the front end. So you can start to see when you apply some of these assumptions how things change if you're applying principal only or principal and interest to the share release. But all of these things are typically laid out early on in the transaction as to how we calculate the share release on an annual basis. That's pretty much how our financial statements get affected from a debits and credits standpoint on an annual basis. Looking at some of the financial statement disclosures that are required, and again, this is on the company side. This is when we're looking at the company financial statements. You know, we need to have a description of the plan and a basis for the contributions. So the purpose of the plan, what's the qualified status, possibly the contribution formula, and maybe a description of the securities held. So something describing how the plan was set up, what's included, and why we have it. A description of the accounting policies for the ESOP transactions. Typically, this is where you're going to include your loan description. You know, any terms that you have on that inside loan, the interest rate, the payment commitments, anything the company is responsible for regarding that inside loan. The compensation cost, that non-cash expense that we record annually, that should be disclosed for the time period that we're reporting on. We should also have share detail. We should be showing the total number of allocated shares, total number of unallocated shares that are held in suspense. Whatever is going to be released or committed to be released should be disclosed separately as well for the period that's being reported on. And ultimately, the fair value of the unearned ESOP shares. So we should take the total amount of unearned ESOP shares at the current fair value that's done annually and disclose what that would be. Finally, regarding the repurchase obligation, remember, there's no requirement to actually record the projected repurchase obligation, even if it's significant to the financial statements. Instead, what we report is the fair value of the shares allocated as of the balance sheet date. These are essentially the shares that are subject for future repurchase obligations. So that's how that ends up getting reported. To the extent that any shares have been put before the end of the year, we'd actually have to book the liability. You wouldn't just disclose it. So that's something that has to be taken into account within the financial statements. So Pete's going to go over now some of the S-Corp owned ESOP issues. Yeah.
Bill?
Yep.
Before you get into the S-Corp issues, we have another comment question, hoping that perhaps you can touch on accounting in situations where the ESOP loan but no bank loan. Okay. In other words, it could be financed. The transaction could be financed by the sellers.
I mean, yeah, we've seen situations where the financing can come really from the bank and the sellers too. And either way, it depends on if you're a C Corp or an S Corp and the way it's set up and how you set up that inside loan, if it's a mirrored loan or not.
But I think essentially, Jay, maybe the question was, this is Pete again, that would the accounting differ if it was a seller finance versus a bank finance? And really it would not. You know, the issue from an ESOP point of view is what shares are being purchased. Because again, these shares that are being purchased inside the ESOP are not allocated to the participants. They're all held in a suspense account. And that's why the money goes in, and either a bank, if the company is, I'll say, lucky enough to be able to finance the entire purchase, the bank will loan money typically to the company. The company loans it into the ESOP, and then you use that proceeds to buy the shares, and the shares then stay in the suspense account. But on the books and on the financial statements of the company, you book that loan as a loan payable by the company to the bank, and that's the credit, and the debit is unearned ESOP shares. Now, if we just say that the seller finances, that there was no cash that was plopped into the ESOP, but instead there was a note, so that the ESOP, and typically this would be a direct loan to the ESOP, so the seller sells his $3 million, in our example, that $3 million, let me go back to the, I don't know, can you, if the seller loans money directly or the ESOP buys the shares directly from the seller for $3 million, and rather than in this situation, instead of saying the bank, we have seller, and he sells his $3 million worth of shares to the ESOP, and the ESOP does not give him cash but a note, nothing more than a note. So there's no mirrored loan here. What happens on the financial statements of the company are essentially as Bill has described. You book the $3 million debt rather than note payable bank, it's note payable seller, and the debit is unearned ESOP shares for $3 million. As then the company makes these contributions to the ESOP, deductible contributions to the ESOP, to then pay the seller the amount of each principal and interest each year, then everything is the same thing. The shares are released, they go to the participant's account, and on the company's books, we reduce the loan, and we look at the shares released from a GAAP point of view, which is different than from a tax point of view. But from a bank point of view, the shares are released. We multiply those shares times the year-end valuation or appraised value per share. We multiply that out, and that's the compensation expense. And anything above or below the original cost is driven into paid-in capital. But essentially, whether it's the seller or the bank, whether it's the seller or the bank, the accounting doesn't change. So hopefully I answered. If I didn't answer the specific question, please feel free to send another one in. What we wanted to do, though, also is in this 101 accounting is also kind of get into some tax incentives, and there's some pretty strong incentives for ESOP companies. You know, as Bill described, typically companies that form ESOPs, you know, in our experience, and we've been doing ESOPs for 30 years now, or longer, that typically you want to make sure that, one, the company has the culture where an ESOP would fit. Typically, ESOP companies are, you know, the ESOP Association has said that ESOP companies are much more productive. They fit, they share information, not compensation, but they share other company information. Also, you want to make sure that you have a wage base that's sufficient to fund the debt requirement. You also, valuation is an important issue because you have to have a willing, not only a willing buyer, but you have to have a willing seller. So to make sure that the seller is willing to sell for that. And then just as important is that you have to have knowledgeable advisors and banks that know what's going on and what impact will happen on the company's books to make sure that, especially with bank covenants, that bank covenants aren't violated just because you've had a very successful ESOP and the stock price keeps going up, and suddenly from a GAAP point of view, because as Bill described, from a GAAP point of view, if the value goes up, compensation expense goes up. Now it's a non-cash contribution or a compensation hit, but it's still a hit. And if the bank documents don't take that into account or perhaps exclude it, you may find yourself into some difficulty if you have requirements in terms of income or other kinds of requirements. So those are some of the things that you have to keep into account and or take into account when you set these things up. The next issue is that we wanted to talk about, and this is really the hottest issues that has hit ESOPs, and I think in the last 30 years, and that is an corporation-owned ESOPs. Up until 1998, S corporations could not own ESOPs, so that an S corporation could only have qualified certain shareholders that would qualify as S shareholders. And just to kind of back up, an S corporation is a tax fiction. It's a corporation for legal purposes, just like any other corporation. But under the subchapter S part of the Internal Revenue Code, there's an election that you can make, the company can make, and its shareholders, as long as they're qualified shareholders, that says rather than the corporation be taxed on income, the shareholders will be taxed on their proportionate amount of income based on their stock ownership. And so accordingly, the shareholders are taxed on the portion of the S corporation income, not the corporation. And for a long, long time, only individual and certain entities could be as shareholders, and those individuals are U.S. citizens or residents, and that, especially where you have larger S corps, that may sometimes be a problem if you have an international company that's based in the U.S., and you may want to provide that you have shareholders that may not be U.S. citizens and residents. So it's one of the things to keep in mind. Certain trusts can be ESOP shareholders, and starting in 1998, ESOPs. And an ESOP is a qualified retirement plan, as we said earlier, that does not pay tax on its current income. Just like an IRA or any kind of profit-sharing plan, income that it gets from selling stock or dividends from IBM that it may hold as an investment would not be currently subject to tax. Also, again, that started in 98, the portion of an S corporation income that is allocated to an ESOP is not subject to federal tax, and in most jurisdictions, not subject to state tax. So in our earlier example, where we had a 30% owned ESOP company, if that is an S corp, 30% of its profits would not be subject to tax. Creates a big incentive for companies to be an S corp because of the shelter that the ESOP provides for its earnings. Now, there are certain inherent limitations on ESOP. One is where it's a minority-owned S-Corp ESOP. And again, where there is only a portion of the S-Corp that's owned by an ESOP, only that portion is not subject to tax. So if we had a company that's 30% owned by an ESOP that makes $1 million, $300,000 of that profit would be allocated to the ESOP and not subject to current tax. However, 70% that's owned by other shareholders would, which typically means that the portion not owned, which does mean that the portion not owned by the ESOP is subject to current tax, which also means that the corporation has to make distributions to those taxable entities that are shareholders to make sure they have enough cash to pay their tax. So again, if the company makes $1 million, 70% is owned by non-ESOP entities that are taxable, then $700,000 would be taxed to them, and they may need $300,000 worth of cash to pay their tax, which is fine and good, but unfortunately, when you make a distribution on some of the stock, you have to make a distribution on all the stock for an S-Corp, which means a proportionate amount of cash distributions have to be paid to the ESOP. Normally what we have found because of that is that where there is an ESOP, and it's an S-Corp ESOP, pretty quickly the seller, and maybe this is right from the start, as well as management, want to get to 100% owned ESOP a company as possible, because where the ESOP owns 100% of the company could make $1 million or $1 billion, and they would pay zero federal tax. So when you're not paying any tax, you can see the enormous advantage you would have over a competitor, and also the enormous amount of cash flow that would free up to help you service the repurchase liability. Now, there are some inherent limitations on an S-Corp. Again, there's some certain shareholder limitations. There are also a limitation on the number of shareholders that you can have. You can't have more than 100 shareholders in an S-Corp, but for ESOP purposes, the ESOP trust, the plan is considered one employee. You don't go down and look at all the participants and count them as separate employees. The trust itself is just one employee, is one shareholder rather. But additionally, from an S-Corporation point of view, the Section 415 limitations, remember I had said earlier that you can only contribute into the ESOP based on a percentage of the wages of the participants covered, and that's 25%. For a C corporation, that 25% is only for principal. It does not include interest. So you don't have to count the interest against that 415 limitations. With S corporations, you do. Additionally, which we'll cover in a minute, there's a loss of Section 1042 deferral, and that's an advantage that the seller would have. Currently, it only is available to the selling shareholders of a C corporation. And sometimes you get into a situation where you have an existing S-Corp that wants to form an ESOP. The selling shareholders want to do this Section 1042 deferral. And so in order to do that, it has to be a C Corp. They elect to be a C Corp, do the transaction, the seller gets the benefit, but unfortunately, in the event the company elects to be a C Corp, it cannot become an S Corporation for 5 years. So again, where you were an S-Corp, elect C to get this advantage, and then now you have to wait 5 years in order to get the advantages of being an S-Corp owned ESOP. And one of the things that happens where you're an S-Corp ESOP is that again, you're not paying tax on the earnings each year, and so contribution deductions become immaterial. And this is where we get into that mirrored loan again. In our practice, typically where you have an S-Corp that forms an ESOP, you normally, where we have these inside loans and the outside loans and the mirror loans, Normally in that situation, you would want to have you typically to match the deduction for here we go. Normally, in this example, where we have the inside loan and the bank loan, if this was a C Corp, you normally want to mirror a loan because you want to make sure that as you're paying the bank down, you're getting a deduction for tax purposes, which helps you with your cash flow. Where you're an S Corp, and assuming that this company was 100%, the company in this example was an S Corp, and it was owned 100% by the ESOP, deductions become irrelevant. So normally in that situation, we have a loan, the inside loan here, being perhaps 20 years. And this loan between the bank and the company is really dictated based on the financial requirements of the bank. And, in our experience, normally it's 5 to 7 years. And you may have, a 10-year amortization with a balloon after 5 years, but typically it's something like that. But again, the shares released are all predicated on the inside loan. So the longer, typically, the better, because that means there's less shares being released, the repurchase liability becomes that much less, but the share of release that you have to use then becomes what is not the special rule, which is based on principal, but rather it is based on the principal and interest formula that Bill went over earlier. So sorry, I'm just trying to click onto this slide. So again, there are some inherent limitations. There is Section 415, but one of the things to remember that even with an S corporation, the ESOP accounting is unaffected. Again, the loan, you book it as a loan on the balance sheet of the company. The corresponding debit is the unearned ESOP shares. Those shares are released as they're paid down. As the shares are released, the unearned ESOP shares are reduced based on the original cost. With an S Corp, again, tax provisions are not necessarily. That's even if it's a minority ESOP-owned S Corp, because it's not the company that pays the tax, it's the shareholders. So there's no tax provision on it, as well as no deferred tax. All that deferred tax liability is eliminated. There are some other inherent issues that you have to watch out for, but typically, again, this is again, a very advantageous issue. Now, one of the caveats that we do tell clients is that, this deferral of or not being currently taxed on the S earnings, that's a creature of Congress. And what Congress gives, it can take away. And some of those situations, there was a proposal recently to take some of these benefits away, and the ESOP groups throughout the country are very vigilant about that, trying to make sure that these incentives are kept in. Because you can imagine that if you had based the buyout of shares based on being an S Corp and not being subject to current tax, if that benefit is taken away, it would have a dramatic effect on cash flow. So hopefully, again, it's been in place since 1998, and hopefully it'll be in place for a much longer time. One final... Yes.
We might want to jump in here to handle a couple more questions, if you can see them. One has to do with your discussion on S Corp and advantages, disadvantages to leasing fixed assets under an S Corp.
Yeah, one question is, in each successive year, this is the regular rule under the regulation. In each successive year, when calculating the number of shares released, is a computation based on the current year's principal and interest, that's the numerator, divided by the current and remaining principal and interest payments. Yes, that's the remainder. So it becomes a smaller fraction. So, for example, I think you had it back here. Let me just flip to the... Is that... Bill,
the shares released.
Yeah, the shares released. Essentially it's a formula, and that's based on the regulations. It is shares and principal to be paid plus the current year's principal and interest. That's the denominator. The numerator is the current principal plus interest. And you might ask the question, well, if I have a variable loan, how the heck am I supposed to know what the future interest is going to be? And what the regs say is that you look at the interest rate for the current year, the last day of the year, what interest rate is in effect. You assume that's the interest that's going to be in place for the remainder of the loan term. And essentially, as and Bill found the slide. Here it is. Calculations based on the loan payback principal plus interest for the year divided by the principal and interest for current year plus all future years. And that essentially, when you go through the formula, that front loads more of the shares being released in earlier years than later years, than if you have just the principal only. And I think there was another question. Generally, would it be more advantageous to lease fixed assets under the S corporate structure since no tax shield is available by tax depreciation on assets? Yeah, I think what maybe you're getting at is that there's this bonus depreciation. Oftentimes, it's funny where you get so used to analyzing business transaction based on after-tax results that you have to then step back if you're a 100% owned ESOP company and decide whether, if you're not paying tax, perhaps it does make more sense to lease than to buy because you don't have that big slug of depreciation up front, which helps you in your present value calculation because of the tax shelter and things like that. So it does become a little counterintuitive sometimes. And then just one final, because it looks like we may be running out of time. There is a special incentive for sellers, and essentially what this is the Section 1042 transactions, and this might be why years ago you'd see a lot of ESOP companies that were 30% owned, not 40% owned, not 20% owned, but 30% owned. And that was really oftentimes because of this 1042 exchange. And essentially what it says is that a selling shareholder may defer gain on the sale of shares to an ESOP if the ESOP owns at least 30% of the outstanding shares of the privately owned C corporation after the transaction. It's got to own 30%. The seller had to own at least the shares for 3 years. The seller, and this is really critical, makes a timely election, and then the seller must buy qualified replacement securities within 3 months before and 12 months after the sale. And, a qualified replacement property is any stocks and bonds of U.S. corporation, whether public or private, that don't have more than 25% of its gross income from passive sources and doesn't have more than 50% of the assets. It has to have at least more than 50% of its assets in an active trade or business. Unfortunately, it doesn't include U.S. government bonds, muni bonds, mutual funds, limited partnerships, or stock incorporation that was subject to an ESOP transaction. And essentially what happens is, and also the company must consent to be subject to an excise tax in the event the stock is sold to the ESOP, that is subject to the ESOP within 3 years. And the seller that who takes advantage of the 1042 are certain individuals. I'm sorry, let me back up for a minute. So, for example, in the example we've been using, I'm a seller. I sell 30% of my stock that I own for 3 years to this ESOP. It was a C corporation when I did it. When I sold it to the ESOP, I get $3 million back. I go on the stock exchange, buy IBM stock, Apple stock, IBM bonds, and all. And if my basis is $1 in that $3 million shares that I sold, that $2,999,000 gain I would have had, I do not pay tax on it currently. I defer that tax until the underlying property is sold. And if I hold it till I die, I can get the dividends during life, which I would have to pay tax on, and as well as the interest, which I would have to pay tax on. But at my death, I get a stepped-up basis, and I can potentially escape all income tax on those shares that I repurchased. That was very popular years ago when the capital gain rates were 28%, even at 20%. When it fell down to 15%, a lot of sellers felt that it was cheaper to pay the 15% and then be able to use the proceeds any way they wanted rather than pick a basket of stocks and bonds today and hold them until sometime in the future. We expect to see more of this, though, with the capital gain rates climbing to 20%, and especially with the new Obamacare Affordable Care Act tax of 3.8% on capital gain transactions like that. But unfortunately, this only applies to C corporations that sell to an ESOP, not to S corps. There have been proposals in Congress to change that to allow S corps to take advantage of that, but so far that hasn't happened. And I think we have, I think it's just about 11 o'clock. I don't know if there's any other questions, Jay, or I didn't.
You're 11 o'clock right on the button. Thank you so much. If there are any other questions that our attendees have, please put them in the chat box, and we'll try to address them right here. If not, and you have questions, don't hesitate to contact Pete and Bill. You see their contact information in front of you right now. We really appreciate having all of you in attendance today, and hopefully you can attend more of our webinars in the future. As I said at the beginning, we will archive this session for future viewing over our website, so please visit our website for those details. I just want to mention a couple events that are coming up, and they're both webinars. October 9th, I believe that's a Wednesday. We've got an administration topic presented by Sharon Hearn and Alex Mounts of Craig DeVault. And on October 16th, we're going to talk about benefits in general and how your other benefit, the other benefits in your benefit package at your companies can complement the ESOP. And that'll be by Dan Remenschneider of Brunner Cox. Looks like we have one final question here. Do you see it, guys?
Yeah. How does the equity contra account get reduced? What is the calculation? Remember, when we book that contra equity account, that's the unearned ESOP shares account. And as shares are released, those released shares get relieved at the original cost basis of the shares. So you can see in this example, regardless of the fair market value of the shares at the end of the year, the unearned ESOP shares is credited for the amount of shares released at the original cost basis. So in this example, it's 3,000 shares released, $100 per share is the cost basis. So that original contra equity account is relieved in this particular year for $300,000. So as each year, as we have shares that are released, they're released at that cost basis. Okay?
Great, thanks, Bill.
Yep.
Finally, everyone, you will receive an email feedback form, and please give us some input so we can provide future subjects that you want and need, and we can improve our presentations. With that, we'll end the webinar, and thanks very much for attending.
Thank you.
Thank you. Please stand by.